Hello, ladies and gentlemen. I am the Acca tutor, your number one Acca tutor online. Um, my name, it's Jeremy Tipkulu, and in this video, I'm going to take you through an area called performance measurement. All right. We have been covering a lot of topics so far, and this one is our last topic, and we just have to, call this paper, management accounting paper, goodbye because we uh, we have, completed all the aspects which were required for us to study. Now, performance measurement is an area that deals with the assessment of performance an, or evaluation of how employees or managers have been doing their duties, all right, or how well the production processes were being carried out. All right, so there are certain aspects we need to know or we need to cover. All right, and in this short video, I'm going to speak about some of them. All right, for example, we need to know what a mission statement is. All right, because this statement is actually important for businesses to succeed. A sound mission statement means that, facilitate the success of a company or a business. All right, so care should be given in the crafting and communication of this statement. All right, so the higher direction of an organization requires a clear vision in general terms of what the organization should be doing in the longer term and how it should go about doing it. All right, so this direction is usually given in this statement called mission statement. All right, so there are various characteristics or attributes that should be present in a mission statement. There should be some purpose. Okay, the statement should have purpose. Okay, when we are talking of purpose, we are saying it should communicate the purpose of the organization or the reason why the company exists. All right, it should also speak of the company's corporate strategy. All right, this is the range of activities in which the business intends to compete and how it intends to compete. Then policies and standards, they are also communicated within a mission statement. And when you are talking of policies and standards, these are just guidelines which help staff decide what to do to carry out the strategy. And lastly, the values. These are the beliefs and moral principles which lie behind the firm's culture. So an example of a mission statement of a real company is that of Simbisa Brands Limited, which is a Zimbabwean listed company which is into fast food industry. Okay, the fast food industry. If you remember the Chicken Inn brands, all right, the Nando's and so forth, they are part of the Simbisa brand. Brands. So its mission statements says to empower our people to always deliver the best in world-class restaurant experiences to our valued customers. So you can see that in this particular mission statement, the company has a vision to ensure that its customers are empowered, enjoy the best restaurant experiences ever. All right, so there is an interest in upholding quality in the production processes of their fast food. All right, but there is also an issue of maintaining this quality. How do they intend to maintain the quality? By empowering their employees, their people, and by calling their employees their people, this actually embeds or enshrines a sense of belonging, a sense of loyalty to the company, okay, by the employees. The employees will feel that they are part of the team, they are part of the corporate strategy. So this is an example, ladies and gentlemen, of a real life mission statement. All right. You can also see that as we have said that the purpose is to be communicated, you can see that the main purpose of this company is to provide restaurant services, and these have been spelled out in the company's mission statement. All right, now let's talk of the goals and objectives. Now, having decided on the company's mission, it is then necessary to have goals and objectives. Why? Because we can't, the mission statement needs to be operationalized, needs to be broken down, okay? Just to be broken down into pieces so that we can tangibly try to do something to ensure in aggregate that we reach to the direction which is being dictated by the mission statement. So goals are statements of general intentions, whereas objectives are more specific. An example of a goal is that to improve profit. But how do we improve profit? We need to set a tangible, okay, something that can be achieved, an achievable objective. So an example of an objective is to increase the profit by 20% within 2 years. So it is actually tangible to say we want to increase this profit by 20%. Whereas to simply say we want to improve profit, we do not know to what extent. There should be some realistic target so that people will then work towards that objective. Now, in the process of attaining objectives, we need to also consider the critical success factors and key performance indicators. All right. Now there are two parts to this. First, we must decide what are the critical success factors, which are the performance requirements that are most fundamental to being successful. Critical success factors are those attributes, okay, or requirements which we need to meet for us to be competitive, for us to compete with others. Otherwise, we might have a good mission statement but end up failing. Okay? So we need to determine those attributes which will make us competitive. For example, having quality personnel, having good supply chain connections, having good infrastructure, good buildings, and so forth. Okay? Or good customer care. Those are the critical success factors. For example, two of McDonald's critical success factors could be quality and speed of service. When we are talking of quality, this should be McDonald's offers high quality service. Sorry. It also offers quick service. So on top of good customer care and so forth, and good, quality food where they offer their service, or their products, they are of high quality, and they also complement that by being quick in the way they do or they deliver. All right. So those are the attributes which make them very competitive. All right, but we need to measure them. We need to measure those critical success factors. All right, how do we measure them? We use what are called key performance indicators, the KPIs. All right, so these are the aspects to which we can assign numbers. We can assign numbers to them, so that we can be in a position to objectively measure. Okay, so when you assign a number, you can objectively measure if you are doing it right or wrong. Okay, so for example, McDonald's might decide to measure quality by asking customers to complete a questionnaire or a form scoring the quality between 1 to 5 and then recording the average score. They could decide to measure speed of service by keeping records of the time taken to serve each customer and recording this average service time in minutes. So, as you also see, as we proceed with the chapter, you also be in a position to understand what actually are key performance indicators. We'll talk of those ones. All right, but remember, these performance indicators, the key performance indicators, could be financial or non-financial. Okay, could be financial, for example, measures of profitability, and non-financial, for example, measures of quality. Now, as you can see here, in short, we have what is called a mission statement. All right, we have a mission statement at the top. We need to have a good and sound mission statement. All right, so this encapsulates the vision of top management, what they are trying to achieve and how they wish to achieve it. It is an important part of the process of controlling the whole organization. Then we need strategic objectives, all right, which are quantified. All right, they are, they are the quantified version of the mission statement because they give the time scales. For example, we want to achieve this within 3 months or within 6 months, and how much in terms of percentages, how much increase in profitability are we expecting? So we assign a percentage, say 5% or 10% in the next 3 years. Okay, then we have critical success factors, which are performance requirements that are fundamental for us to compete. Then key performance measures, indicators. These are the measures to assess whether the critical success factors are being achieved. All right, lastly, we have operational objectives, which are day-to-day targets. Okay, each function or each department is given day-to-day targets which it has to meet. Then tactical, these are related to functional objectives. They are functional, all right, to control individual functions. For example, to see if the marketing function is doing what it should be doing, if the finance department is up to scratch, is doing what it's supposed to do, if the production department are also doing what they are supposed to do. Then when you are looking at strategic objectives or strategical objectives, these are long-term objectives for an organization. Okay, now let's talk of a very important matter here called short-termism. All right, short-termism. Now, we are talking of short-termism. Short-termism. Right, this is one word. Short-termism is a bias. Okay, it is a bias towards short term. Okay, a bias towards short term rather than long term performance. Okay, of the organization. All right, so it is usually due to the fact that managers' performance is being assessed based on short-term results. All right, if we are evaluating the manager's performance based on short-term results, we end up having a problem of shortism. I mean short-termism. Okay, where the managers would end up neglecting the long-term focus or long-term sustainability of an enterprise and ending up doing or engaging in those activities which only offer short-term benefits. All right, so organizations have to have a trade-off. Okay, you have to make a trade-off between short-term and long-term objectives. All right, so decisions involve, decisions which involve the sacrifice of longer-term objectives might include. So, examples of decisions. All right, which are inclined towards the short term. Okay, this includes neglecting or postponing capex. All right, if a company if a company's managers are having a tendency of neglecting or postponing capital expenditure, their focus would actually be in the short term. All right, and this might be motivated by the fact that they fear that if they have capex, all right, capex comes with accounting costs. For example, depreciation. If you increase machinery, all right, by the end of the day, there are going to be some additional depreciation costs. All right, so if managers are being evaluated based on short-term profits, the managers would fear that by the time the capital expenditure, for example, the machinery will start to add more profitability in terms of increased production. That might be maybe after 3 years. So managers fear that while it's in 3 years there could be profit, but in the first year and second year, the depreciation charge might be eating on their profitability. So if managers are being assessed on profitability, they end up neglecting capital expenditure because they fear that the depreciation charge might eat on their profits. Okay, so this is one example of a short-term decision. Then the other one is cutting down on R&D. Okay, cutting down on research and development. This is also an example of a short-term decision. A decision with short-termism. Okay, where companies managers might fear that the R&D will not yield and profitability in the short term. So, because usually research and development activities, they do take time, okay, and sometimes they end up not being successful. So, and if they are not successful, then they become a cost to the business. So managers who are being assessed based on the short-term activities or performance, they end up cutting down on research expense because they fear that it is an unnecessary cost. They fear that it will eat down on their performance assessment. All right, but that would be at the expense of the long-term future or long-term development or success of the company. All right. Another example is reducing quality control activities. Reducing quality control activities. For example, a company might end up hiring few quality inspectors at the expense of quality in production. They end up hiring a few individuals who cannot cope up with the amount of production that is taking place. And by this, they will be reducing the quality control cost, but at the same time, they will be putting the company to danger. All right. So, short-termism is actually bad for a business. But how do we encourage companies? I mean, how do we encourage the long-term view to be adopted? All right. We need to make short-term targets realistic. Okay. The short-term target should be realistic, as if budget targets are unrealistically tough, a manager will be forced to make trade-offs between the short and long term. So in our budgets, we need to ensure that the targets which are set are achievable or are realistic. Otherwise, if we put an out of this world target which cannot be achieved, then the managers will just say it is better to just do what we can do, to just do what we know best, to just do what we can do, you know. And by the end of the day, the short-termism comes again into play. We need to provide sufficient management information to allow managers to see what trade-offs they are making. Managers must be kept aware of long-term aims as well as shorter-term budget targets. So it is very prudential and important to ensure that always the corporate strategy is constantly communicated to our managers. We need to evaluate the manager's performance in terms of contribution to the long-term as well as short-term objectives. So by the end of the day, we are not saying short-term targets are bad, but we are simply saying there should be some congruence, okay, congruence. There should be some complementary, okay, it should be complementary, some complement, all right, between the short term and the long term objectives. All should move in one direction. Then there is need for a link, in terms of managerial rewards, all right, they should be linked to share price, all right. The rewards of the manager shouldn't be independent or divorced away from the share price. There is need to link this reward to the share price. This might encourage congruence. Okay? This might encourage congruence. All right? For example, if we say the manager is going to be paid based on the percentage of share price. For example, his remuneration would be, let's say, 30% of the share price. Obviously, whatever his action would be, they would be inclined towards preserving or improving the share price, because you will be knowing that his share price, his reward is based on the share price. So whatever he will be doing will be inclined towards preserving value. Okay, and by so doing, he would also be maximizing the shareholder's wealth. We also need to set quality-based targets, as well as financial targets. Multiple targets can be used, and we'll see how to craft these multiple targets as we go down through the lecture. All right, so these could actually assist in encouraging a long-term view. Now, we need to move forward to an area called benchmarking. Benchmarking is an attempt to identify best practices and, by comparison of operations, to achieve improved performance. So, when we benchmark, we'll be attempting to identify best practices, what the industry is doing versus what we are doing. So benchmarking is a type of comparison exercise through which an organization attempts to improve performance. According to the Siemens Offshore terminology, benchmarking is the establishment through data gathering of targets and comparators through whose use relative levels of performance and particularly areas of underperformance can be identified. By the adoption of identified best practices, it is hoped that performance will improve. So this is according to the Chartered Institute of Management Accountants. All right. Now, let's list 4 types of benchmarks. 4 types of benchmarking. All right. The first one is the internal benchmarking. All right. This is a method, okay? This is a method of comparing one operating unit with another within the same org. So, internal benchmarking is a method of comparing one operating unit with another within the same organization. So, for example, the production department could be benchmarked against the marketing department within the same organization to see if these guys are actually doing it well, or which of the guys would be doing according to our strategy. Then there is functional benchmarking. Okay, here internal functions are compared with external ones. Okay, for best practices. So we'll see our production department being measured or being compared with those departments of other entities. All right. So to say, those entities could be in a different industry. In a different industry, it doesn't matter. The idea is we just want to benchmark if we are following sound business practices. For example, benchmark our finance department with that of another company, which could be in the same or in a different industry. Okay, to see if we are at least doing financial activities which could be considered best practice. All right. The third one is competitive benchmarking. Competitive benchmark. Okay. Now here information is gathered about direct competitors through certain techniques, such as reverse engineering. Okay, so we'll be using techniques like reverse engineering to see if we are doing things right. What is reverse engineering? All right, reverse engineering is where we buy the competitor's product. The competitor's product, and we dismantle that product. Okay, in order to understand its content and configurations. So this is actually common in technology industries. Okay, for example, in the mobile phone industry, we see such things taking place, right? Where after just 2 months, you could see that a more outstanding technology is no longer outstanding because every cell phone would be capable of just performing the functions which were 2 months ago outstanding or salient. All right. So the idea there is these manufacturers, they to some extent end up do what is called reverse engineering. This helps them to cope up with the pace of others. Otherwise, if they just operate in an island of themselves, they end up lagging behind. So to keep abreast, to keep pace with the changing technologies, reverse engineering is often employed. All right. Then lastly, we have got what is called strategic benchmarking. All right. Now, strategic benchmarking, ladies and gentlemen, is nothing new. All right. This is just a type of competitive benchmarking designed to assist strategic action and organizational change. Okay, so it is actually designed to benchmark, okay, the apex of the organization, all right, where the top brass would be actually assessing their long-term vision against what the competitors are doing, all right, to see if the strategy is actually sound or is it still sound. All right, unless we benchmark what we think against what others are thinking, we will not be able to pinpoint if the direction we are still taking is the right direction. So we need to actually benchmark or compare our vision with that of others to see if we are still doing it right. So basically, what's the importance of benchmarking? Why do we need to benchmark? All right, the first one is number one, benchmarking allows attainable standards to be established and utilized. Sometimes we might be worried why there is this high labor turnover, why employees are leaving our company. Uh, the reason could be obvious, that our targets are out of this world. They are not achievable. They can't be attained. So if we benchmark our process, our targets with those of our competitors or other guys in the industry, we could see if we are actually assigning employees, what an average employee can achieve. Otherwise, the target would be out of this world, would be unattainable, and by the end of the day, it frustrates employees and they leave. So if we do benchmarking, this allows attainable standards to be established and utilized. Okay? Now, the following reasons. Okay, number two is actually having, the reason, it's a form of a generic statement, all right, where we have a lot of advantages, rather, okay? The first one is as it is done or carried out by managers responsible this would ensure the managers live up with changes that comes with it, and this fosters implementation, full implementation. So, in simple terms, we are simply saying, as the managers participate in the benchmarking exercise, whatever the outcome of the benchmark, the managers will be forced to live by the results of the benchmark and to ensure there is full compliance or full implementation of the new changes. All right. For example, when we carried out a benchmark, we discovered that we were, okay, our targets were more lenient than what others are doing. Okay, so obviously we will be forced to add some extra workload, but this would actually mean that the manager would be forced to follow the new burden, and this would be at the advantage of the company. Or we could have found that we were overstretching our employees, and with the results of the benchmark exercise, we would be forced to lower down our targets. All right, and this again would mean that we would have to implement the changes. All right, then the other reason why benchmarking is important is usually it is meant to improve performance of key business processes. So, through the benchmarking exercise, the main or the core business processes are going to be improved. All right. You can also appreciate that benchmarking gives early warning signs on whether we are doing it right or wrong. Okay, it gives early warning signs on whether we are doing it right or wrong. All right, that's all, ladies and gentlemen, and the rest is actually written in the notes. We have our notes, and we just have to refer to those notes, ladies and gentlemen. Now let's talk of divisional performance measurements. All right, and I'm sure you should be aware of only two ways. All right, of measuring profitability of a division. All right, we need to be aware of those ways to see if we can measure a division. So these ones, they should be, yes, the return on investment and the residual income. All right, so the return on investment is also called the return on capital employed, and is calculated as the profit divided by capital employed multiplied by 100%. Okay, and we'll be using operating profit. When you are saying profit in this formula, it simply means operating profit, and operating profit is let me look for a pen. Operating profit is profit before interest and tax. That's the profit we are referring to, ladies and gentlemen. Okay, that's the profit we are referring to, and major measure of efficiency of profit-making organization. We are simply saying this this ratio or this measure is considered major. Okay, the measure of efficiency of profit-making organizations. It measures efficiency with which capital employed, which is the input, used to generate profit, and profit is actually considered the value out of output. If return on capital employed is 30%, this means that 30 cents of profit is generated for every dollar of resources. It is increased by improving profit margins and or increasing asset turnover. All right, the asset turnover is the ratio we also need to appreciate, okay, where we are saying sales over capital employed. All right. Okay. So when we are talking of capital employed, we are simply referring to those assets which are of capital nature. Which constitute capital expenditure. All right. So those assets which have been invested by the business to constitute capital expenditure. So they involve non-current assets, all right, plus investments, plus current assets, less current liabilities. All right. So usually we are simply referring to all the current assets. All the assets which we have as a business, but we need to single out or to remove the current liabilities. Then we have what is called capital employed. So it includes current assets, non-current assets plus investments plus current assets less current liabilities. Sometimes it is capital employed can also be determined by having ordinary shares plus non-current liabilities. This could also give us the same figure. All right, ordinary shares plus non-current liabilities, or non-current assets plus investments plus current assets less current liabilities. Okay, but the ratio is an accounting ratio, and it is affected by the age of the assets. If the assets are old, the ratio is also affected. If the assets are new, the ratio is affected as well. Okay, the depreciation rate can also affect the ratio. Remember, it is PBT of capital employed. All right, profit before interest and tax divided by capital employed. So the depreciation charges, for example, they affect profitability, and that would also affect the ratio. All right, then the inventory valuation policy that has been adopted by the business can also have a bearing on the ratio. So there are so many variables that affect this ratio. All right, I think we need to do this example together to see if we can understand this ratio deeply. we are given the turnover of 3.5 million, 3.527,508, the gross profits of that figure, the operating profit, non-current assets, cash at bank, short-term borrowings, trade receivables, trade payables. Then we are tasked to calculate the return on capital employed. Now, return on capital employed, that's the ROS, okay, which we say that this is given by PBIT over capital employed multiplied by 100%. All right, and we say that capital employed is equal to non-current assets plus any investments okay, plus current assets minus current liability. So in this case, the non-current assets were given. They were 29100 plus any investments. Do you have any investments there? Okay, I don't see the investments, but I see I'm seeing the current assets. This one is the current asset. This one is the current asset. So plus 2309791 plus 221222. Okay, and then I'm seeing current liabilities, the trade payables. So we have to deduct those ones, and we must get our figure there as 4,114,997. Okay, so this one is the capital employed part. What about the profit before interest and tax? The profit before interest and tax, ladies and gentlemen, can also be called the operating profit. Operating profit. So in this case, the operating profit was this much, 1814578. So the ROS is therefore 1814578 over 4,114,997 multiplied by 100%. So this should give us how much? Let us use our calculators. So this gives us 44.10%. That's the return on capital employed. Okay, now let's move on to the next part on how to use this ratio. Now, as I've indicated earlier on, ROS is also called return on investment. Return on investment. If the performance of the investment center manager is being assessed, it should seem reasonable to base profit on the revenues and costs controllable by the manager and exclude service and head office costs, except those costs specifically attributable to the investment center. So return on investment is therefore sometimes called, calculated as ROI is equal to controllable or traceable profit over controllable or traceable investment can multiply by 100%. If it is the performance of the investment center that is being assessed, however, the inclusion of general service and head office costs would seem reasonable. All right. Now there is this other ratio we need to uh, determine. All right. But before we go further with that, the residual income issue, I just want to point out that when you are talking of controllability or traceability of costs, we are simply referring to that concept of a responsibility center approach. Okay, if you still remember in our earlier studies, we pointed out that a manager should only be blamed or be rewarded on things which were under his responsibility. Okay, so you can't blame a production manager on the bad things happening in the finance department. It doesn't work like that. You just have to blame a manager on things he has control on. Okay, so that's the idea of controllability and traceability of the cost. Can the cost be directly traced to our department, or they are actually an indirect cost to us? They are not uh, directly our blame. All right, so you can't blame us over those costs. All right, I'm sure we have cleared the air. Now, residual income. This one is calculated as controllable or traceable profit minus imputed uh, interest charge on controllable investment, imputed or notional. Notional interest charge on controllable investment. It is an absolute measure, um, difficult to identify controllable profit. It is usually difficult to identify which profit is controllable. However, the ratio increases as assets get older. It tends to increase, as you will see in the following example. You will discover that the ratio tends to differ with time. All right. Okay. Before we look at this example, that is the coming example, I just want to highlight that an absolute measure is simply um, a figure. Okay. All right. It gives um, numbers only, but it doesn't explain anything. It simply tells us of the actual figure, okay, or of a figure, uh, not in terms of say percentages uh, or ratio, but it simply tells us of the actual amount, okay, or of an amount actually. All right, so that's an absolute measure. For example, 20. If it says $20, this is an absolute figure. But if it says 0.2 or 20%, then that's a ratio um, which gives us more detail about something. All right. So an absolute measure usually needs some target measure. For example, um, for us to know more, we have to be told of a certain target, All right, for example, we expect our residual income to be $500. All right, so if we get residual income below $500, we should be worried. All right, something like that. Okay, so uh, however, it could be informative if we simply say we just need a positive residual income. If it is positive, we are happy, then that's it. When we get a figure that is positive for residual income, we should be happy. So more details will be needed in terms of the interpretation of the residual income. Now let's look at this example. All right. Division M is a division of Amira PLC. The following data um, relate to Division M. We've got net assets 20 million, annual profit 5 million, cost of capital 15% per annum. And Amira PLC is considering two proposals. That is proposal 1, invest a further 2 million in non-current assets to earn an annual profit of 0.4 million. And proposal 2, dispose of non-current assets at their net book value of 5.5 million. This will lead to profits falling by 1 million per annum. Proceeds from the disposal of these non-current assets would not be credited to Division M, but to the holding company of Amira PLC Limited. Instead, required calculate the current ROI and residual income for Division M. All right, so and then consider each of the two proposals to show how the ROI and residual income will be changed if these proposals were adopted. All right, so usually you need to be very fast when you do your computations. Anyway, let's move on. The current ROI. Let's start with the current ROI and we proceed to the residual income. So we know that ROI is equal to traceable profit over traceable investment. Right, multiplied by 100%. All right, so the traceable profit in this case is given 5 million, and then traceable investment that's 20 million, so 5 over 20 multiplied by 100, we get 25%. Okay, and then the residual income, this one is given by traceable profit, okay, minus imputed interest charge, okay, on so traceable investment. All right, so traceable profit, we determine this one as 5 million minus the imputed imputed interest, our cost of capital, cost of capital was 15%, so that's 15%. All right, multiplied by the traceable investment, which was 20 million, and this should give us 5 million minus 3 million. Okay, this should give us 2 million. Now, given these two figures, all right, this first one, we're having a ROI of 25%, and we are also having RI of 2 million. we should be able to interpret. So, for example, the ROI 25% exceeds the cost of capital. The cost of capital, which was 15%, as given in the question. Okay, cost of capital 15%. All right, and the residual income is positive. All right, because this one is a positive figure, it's a plus $2 million. So therefore division M is performing well. That's the conclusion we can give. The residual income is positive, then we can safely say the division is performing well and its return on investment is exceeding the cost of capital. Then we can safely say this division is doing well. Okay, now let's look at a situation where we consider the proposals. Part B there, we need to consider the proposals and show how the ROI and RI will change if these proposals were adopted. Okay, proposal 1, invest a further 2 million in non-current assets to earn an annual profit of 0.4 million. So we are increasing investment as well as increasing the annual profit. So proposal 1. Okay, new traceable profit is equal to the original 5 million plus new profit, which is 0.4 million, and we get 5.4 million. All right, then new traceable investment. New traceable investment, we were having 20 million initially plus a new investment, and in this case the new investment is 2 million. So we're adding 2 million investment. So obviously the new traceable investment is now 22 million. Therefore, new ROI is equal to traceable profit over traceable investment, that is 5.4 million over 22 multiplied by 100%, and we are having 24.5%. What of new RI? This is traceable profit. The new traceable profit is that's 5.4, okay, minus imputed interest charge. Imputed interest charge, the cost of capital is 15%, applied by our 22 million, which is the new investment, traceable investment. This should give us 5.4 minus 15% of 22, that's 3.3 million, and we are having 2.1 million. Okay, we are still happy in this case because, as you can see, this one is greater than the cost of capital, 15%. All right, and this one is positive, which is a good thing. What about in proposal 2? Proposal 2. Okay, new traceable profit in proposal 2. We had 5 million originally. Okay, but we are told that if we do proposal 2, then profits will be falling by 1 million, as we will be disposing of the non-current asset at 5.5 million. That is what is going to happen. So the profit is shrinking minus 1 million, which gives us 4 million. Okay, and new traceable investment is equal to, we had 20 million originally, but we are disposing of the original investment. Okay, and we are going to get 5.5 million. Therefore, our new investment is now 14.5 million. All right, so the new ROI, which is equal to traceable profit over traceable investment. Traceable profit is now 4 million over 14.5 million. All right, multiply by 100%, and this should give us 27.6 million. What of new residual income? We have the profit, and the new profit is now 4 million. Remember, 4 million minus 15% multiplied by 14.5 million. 4 million minus 2.18 million. This gives us 1.82 million. Okay, this these figures say something. Okay, the ROI is above the cost of capital 15%, which is a good thing, and again the residual income is good, is positive. However, we need to make comparisons to see which proposal is the best. So we need to have a summary. Let's have this summary and see if we can make sense out of it. Okay, so we've got the column for current position, then we've got proposal 1 and proposal 2. Okay, all right, so we've got our ROI. The ROI is in percentages. Okay, the current ROI before any proposal, the current ROI was 25%. in proposal, but according to proposal 1, the ROI was how much? The ROI for proposal 1 was 24.5%. Okay, and according to proposal 2, the ROI is 27.6. So these are percentage. That's a percentage, not in money, not monetary. I'm sorry there. It shouldn't be this. It's a percentage, that one. I'm sorry there. Okay, and now the residual income. The residual income initially it was 2 million. Okay. 2 million, and in terms of proposal 1, it was 2.1. And in terms of proposal 2, it was 1.82 million. So if you're looking at this summary table, you can see that we can actually make judgments and see that if we are basing our decisions on the ROI, then proposal 2 is going to be selected because it gives us a higher ROI. Okay, but the idea here is that the residual income, all right, okay, I mean the return on investment shows a higher figure, okay, in terms of proposal 2, all right, whereas when it comes to proposal 1, it is showing a lower figure, all right, because the percentage there is lower, all right. So proposal 2 can be considered. However, if we look at the residual income, we can see that the opposite is true, and proposal 1 can be accepted because um, there is the more income, I mean, the amount of income we are going to get in absolute terms is going to be higher. So the residual income is actually telling us how much in terms of money we are going to actually get, whereas the return on investment is actually giving us a relative measure and not speaking in terms of the actual monies we are likely to get. So you can see that a relative measure sometimes gives us what we need to know in terms of the actual money. However, for us to be convinced if the actual money is something to go by, if something that is meaningful, we also need the return on the investment, which is a relative measure, as it tells us in relation to the cost of our capital. It tells us more given the percentages, right? So we also need to evaluate which one is the best option. Now, for us to actually conclude, especially with regards to proposal number 2, which involves the disposal of assets, we need to evaluate further with ratio. For example, the asset rate of return. All right, we need to, for us to actually see if proposal 2 is actually meaningful, because in terms of money, it is showing us that it is a worthwhile attempt because it gives us more money, but we need to know if we can actually make that decision, if we can choose that proposal. So we need to calculate what is called the asset rate of return. Alright, so this one is actually the change in profit over, sorry, over change in investment, because there is a change um, in the profit. In this case, the change was a reduction of 1 million, okay, over the change in the investment. There was also a reduction of 5.5 because we are disposing of this asset. All right, so this gives us about 18.2 percent. Okay, so um, since the current ROI is 25%, because the current ROI, according to our table, the current ROI is 25%. So any asset with a rate of return less than this, less than 25%, should be disposed of. Okay, so for us to reach to a decision whether we should dispose of an asset or not, we need to calculate the asset rate of return. Right. However, we also need to know that all these decisions should be centered on the goal congruence. Okay, we need goal congruence to exist in all these decisions as to whether we are going to accept whatever proposal we are going to take or to accept. We need to ensure that by the end of the day, the overall purpose of the organization or the overall objective is being followed or is being pursued. That's goal congruence. We need to have a common purpose. We need to achieve a common goal by the end of the day. Okay. These are the advantages of the ROI and the residual income. All right. ROI is a relative measure, whereas residual income is an absolute measure, as already highlighted. Consequently, residual income as an absolute measure of performance is used to select proposals based on the absolute increase in profit rather than the relative increases. This can be demonstrated in the example above, where the ROI increases to 29% with proposal 2, but the reality is that a residual income only increases by an absolute value of 0.2. Okay. Okay. Yeah, there was a typo. All right, I'm sure you realized that. All right. The increase wasn't 29%, but 27%. All right. So it was 27%. proposal 2, as you can see, is 27%. All right, 27.6%. All right, with proposal 2, but the reality is that the residual income decreases by an absolute 0.18 because it moved from 2 to 1.82. Okay, 1.82, which is about 0.18 million decrease. All right, but basically what we are saying is the residual income, being an absolute measure, gives you the information you need to decide whether a proposal is going to maximize your wealth in absolute terms. Okay, this is why I said the absoluteness is in the actual amount you are likely to get, the actual cash flow you are likely to get. So the residual income is actually in support of the net present value principle of project evaluation. All right. Therefore, organizations that maximize residual income will not necessarily, but are likely to maximize NPV in the long run. Therefore, their shareholder wealth. All right. Now there is this other division of performance ratio, or this division of performance measure, that is the return on equity. This one is based, is calculated as the net income over shareholders' equity. When you are saying net income, we are referring to the profit after tax. Right? Over shareholders' equity. All right. Net income is for the full year before dividends paid to ordinary shareholders, but after preference dividend. Shareholders' equity does not include preference shares. Return on equity may also be calculated by dividing net income by the average shareholders' equity. All right, average shareholders' equity is calculated by adding the shareholders' equity at the beginning of the period to the shareholders' equity at the period's end and dividing the figures by 2. So generally, the return on equity measures the ability of a firm to generate profits from its shareholders' investment. It shows how much profit each unit of shareholders' equity generates. Return on equity is also an indicator of how effectively management is using equity financing to fund operations and grow the company. It is expressed as a percentage calculated by dividing net income by shareholders' equity. All right, let us see if we can get an example to illustrate our point. All right, XYZ is a retail store that sells tools to construction companies across the country. XYZ reported net income of $100,000 during the year before preference dividends of $10,000. XYZ had $100,000 for $50 ordinary shares in issue during the year. XYZ will calculate ROI as follows. That's 100,000 minus the preference dividends, okay, divided by the shareholders' equity of 450,000. All right, and this is ordinary shareholders' equity, which is 100 multiplied by 450, $4.50, and we get 450,000. So the ROI is 20%. ROI is often said to be the ultimate ratio or mother of all ratios that can be obtained from a company's financial statement. A company can only create shareholder value if its ROI is greater than its cost of equity capital. Okay, the expected return that shareholders require for investing in the company, given the company's particular risk of business. Okay, I think that is that, ladies and gentlemen. I hope you have enjoyed this first part of our presentation. I am looking forward to have you in the next segment of our performance management video, where we'll be going a step further with our performance measurement uh, topic in those advanced areas, especially on the areas to do with non-financial money, measures. All right. You're also encouraged to practice in these ratios. There are also other ratios which we didn't talk about. Okay, and those ones involve profitability. Okay, we did not talk much of the profitability of the whole enterprise. Okay, where we look at um, gross margins, gross margins, gross margin, uh, then operating margin, okay, or net profit margin, right? We will net profit margin, okay, another ratio we need to appreciate, and the other one is the asset turnover, asset turnover. Okay, the asset turnover, we say that this one was sales over capital employed. Then gross profit margin, the gross profit margin, gross profit margin. This one is given by the gross profit over sales. Okay. What else? What other? Um, then the net profit or operating profit margin. Operating profit margin. This one is the profit before interest and tax over sales. Okay. Those ones are essential. Profit before interest and tax over sales or operating profit over sales. Okay. Multiply by 100%. Don't forget, multiply by 100%. Multiply by 100%. Okay. What else? What else? What else there? For the asset turnover, do not forget also to apply by 100%. All right, then we have got what are called, so these ones are part of the profitability. These ones with profitability ratios. There are also ratios, okay, right, all these ones, we have got them here. Fine, the liquidity ratios, we need to know more about those ones. Okay, liquidity, they only measure our ability to finance short-term activities of the business or the day-to-day running of the business. Okay, are we able to pay our payables in time and so forth? And do we have the liquid cash to do our day-to-day running of the business? All right, so we've got what is called the current ratio, which is current assets over current liabilities, and we normally expect this ratio to be greater than 1. Okay, but we do not want it again to be higher, too much higher, such that we end up having idle cash in our logs or in our bank account, because that would signify some overcapitalization. All right. So that's the idea. This one, the quick ratio, we need then to deduct inventory from the current assets, but it's still the same ratio. All right. All these are the formulas which you need to acquaint yourself with. All right. Okay, the working capital. it's an issue of liquidity again, which we'll be talking about. All right, but also have to appreciate that the working capital period, or the average age of working capital, identifies how long it takes to convert the purchases of inventory into cash from sales, and is calculated as working capital over cost of sales multiplied by 365 days. The ratio can also be calculated as working capital over operating cost multiplied by 365 days. Remember, working capital is equal to receivables plus cash plus inventory minus payable. Right? That's the working capital formula you need to find yourself with. Right? These ones, ladies and gentlemen, you can actually refer them to the notes. All right? They are what are called leverage ratios, or gearing ratio. Okay, gearing ratios. All right, and they are normally two at this level, which we need to understand. Okay, there is what is called capital gearing. All right, and capital gearing is concerned with the amount of debt in a company. Amount of debt in a company as long-term capital structure. Right. So capital gearing is about the amount of debt in a company's long-term capital structure. And when you're talking of capital structure, this is the way the company is financed. All right, whether it is highly financed by debt or by equity. All right, so capital gearing is equal to prior charge capital over prior charge capital plus shareholders equity. Okay, what is prior charge capital? Prior charge capital is like interest bearing capital. For example, loans or bonds or debentures, they are called capital, prior charge capital, if we are going to pay interest on those funds. Okay, on those funds, we are going to refer to those funds as prior charge capital. Okay, that's the idea. It could be bonds, it could be loans, it could be preference shares. Okay, where there is a fixed charge or a fixed dividend to be paid, then we refer to that one as prior charge capital. All right, so that's the first ratio in this category, is this one, the capital gearing. All right, the other leverage ratio we can think of is the interest cover. All right, the interest cover shows whether this one shows whether the company, okay, is earning enough profits before interest and tax to pay its interest obligations. comfortably or without hassle? Is it able to pay its interest comfortably, interest obligations or interest costs? All right. So it is given by interest cover is equal to profit before interest and tax over interest payable. The interest that is payable or that is to be paid. Okay. Now we also need to know the potential pitfalls of ratios. Okay. The use of statement of financial position is dangerous in that they represent only one point in time, which may be unusual due to, for example, seasonal factors. Okay, so normally it depends on at which time you are using the statement of financial position. Sometimes, because of seasonal factors, you might be using a financial position which is not representative of the actual um, happening or actual things obtaining on the ground. Okay, for example, if you utilize a statement of financial position during the peak season of the year, you might end up calculating ratios which are not representative of the financial performance, the general financial performance of the company. Okay, there could be also some window dressing, okay, some creative accounting within this ratio, right? And that might also end up giving you wrong information or wrong assessments. Okay, they only look at the past and not in the future, because remember, accounting information is usually from past records or past activities or events. So the reported earnings or the reported figures could be just outdated. All right, they won't be telling you about what is actually going to happen tomorrow. Okay, so it is backward looking and not forward looking. So the assessment is only going to give you the historical facts of the performance of the company. Now, they are of little value unless used in comparison. You need to have some comparisons or comparatives for you to make informed decisions from those ratios. Okay, I think we've done justice to this topic, and we can safely say let us meet on the next segment of our lecture. We'll be looking at other deeper issues to do with performance measurement. Okay, so until next time, ladies and gentlemen, may you continue to feel excited, very, very excited. I'm signing out. Thank you.